Okay. All right. Tonight we're talking about business expenses. As we talked earlier in the quarter, you are considered by the IRS to be an employee for income tax purposes. You're considered to be self-employed for Social Security or Self-Employment Contributions Act purposes. So, if you do receive a W-2, because you're considered to be an employee, if expenses are reimbursed to you under an accountable plan, then they are not income to you and are not deductible by you. If your expenses are not reimbursed, they are deductible by you on Form 2106, Unreimbursed Employee Business Expense, which then that number would flow to Schedule A and be subject to the 2% of adjusted gross income limitation on miscellaneous itemized deductions. Just as a note here, the recent tax law revision eliminates through 2025, beginning 2018 tax years through 2025, the deductibility of miscellaneous itemized deductions on Schedule A. So if you are an employee and are not getting reimbursed for your expenses, beginning in 2018, you will have no deduction for that. Now, if you receive a 1099, now I know that Brian receives a 1099. What do you get, Justin? You get a W-2 or a 1099? I can't hear.
Well, his thing's got his audio marked out, so I'm not sure.
There.
Mine keeps coming in and out. I didn't hear the question.
What do you get, a W-2 or a 1099?
Can you hear me?
Yes, we can hear you. Can you hear us?
Yeah, it's spotty. It's in and out on me real bad this evening.
Okay, that's odd. Because I hadn't changed anything on my side. Seeing if there's anything I can do here that might.
No, sir. It's from when the line comes into the community I live in, the area I live in. There's certain times a day that the bandwidth tapers down from where there's so many people online.
All right. So do you get a W-2?
It just kind of robs.
Yeah.
I get a W-2.
A W-2, okay. So yes, you would be under that situation we've been talking about, that if you have expenses that you are not reimbursed for, beginning in 2018, you would get no deduction. For prior years, you would have had to fill out a Form 2106, and then potentially deduct some of those things on Schedule A. The 1099 people, they're self-employed and their expenses are fully deductible on Schedule C. Well, let me modify that a little bit as we get to the end of the class today. We'll talk about the Deason rule, which will change that. That situation will not change under the new tax law, although the new tax law does give a potential 20% exclusion from tax on self-employment types of income, as well as other types, sub-S corporations and partnerships where you're active in the business, etc. There's a potential 20% exclusion from income there under the new tax law.
I got a question real quick.
Okay.
Say like next year, whenever I've talked to my congregation about my housing allowance for this coming year, and we're fine with that. We're going to get that in writing. But okay, say next year, because I don't make enough for it to even cover my rent for the year.
Right.
So that'd be 100%, free from the income tax.
Correct.
So would it do me any good to keep track of my expenses as far as, would that make any difference as what we're talking about now?
If they're going to continue to pay you on a 1099, yes.
So that would, even though the income tax would be completely taken care of by the housing allowance?
Yes, even though the income tax would be completely taken care of by the housing allowance, when you get into calculating self-employment tax, you add back the housing allowance piece. So you've got to do a separate calculation in essence to figure out what your expenses are, or what your income would be for self-employment purposes. So from that standpoint, if you continue to get a 1099, I would track it so I could deduct it against my Schedule C income for self-employment purposes.
That makes sense. So I should be able to do that even this year, correct?
Yes.
Okay.
And for every dollar of unreimbursed expense you have, in your particular situation, we talked about you're in that 15% tax bracket, marginal tax bracket, and the self-employment tax is 15.3%. And I don't know what your state income tax rate is. Where are you? Kentucky?
Missouri.
Missouri. I don't know what their base state rate is. I know in Georgia it's 6%. So, you're at 30% plus whatever the state rate is in savings on every dollar of unreimbursed employee business expense you've got.
Okay.
It's
that can't,
worth it to track.
That can't go above 20% though, right? Or am I reading that wrong?
No. You're reading what I added in that last paragraph in parentheses?
Yes, sir.
Okay. Under the new tax law, you're reading that incorrectly. So let me explain what I mean by that. Under the new tax law, people who are self-employed have the potential, depending on their income levels, and the income levels we're talking about, it would happen here, to exclude 20% of their income from tax. Now,
and that's under the new law.
That's under the new law that took effect January 1st of 18.
Okay.
Just like that statement under the first paragraph, under the new law that took effect January 1st of 18, you can no longer deduct miscellaneous itemized deductions on Schedule A. The Congress just did away with those. So updating, trying to keep the slides current for 17, you could do it, but for 18, you can't. So just somebody there in your situation that got a W-2, it's not going to do them any good to track their expenses unless they're still subject to self-employment tax on their ministerial income. Then they need to track it to subtract it from their self-employment income to calculate self-employment tax.
Okay.
All right. When you use your personal vehicle, you have two choices. You can either claim actual expenses, which in order to know that, you have to track your business usage versus your total usage, calculate a percentage. So if you drove 12,000 miles and your business use was 5,000 miles, then you get 5/12. That's what, about 40, somewhere around 41.67%. You get that 5/12 there of your total actual expenses. The other option that you have is to take a standard mileage rate. And every year the IRS publishes a standard mileage rate in mid to late December. For 2018, that standard mileage rate is 54.5 cents a mile. For 17, it was 53.5. So it changes to some extent every year. It's been as high as, say, 57.5 or 58, but it's somewhere usually in that mid 50 something cents a mile. So you have that choice to make. Am I going to take actual expenses or standard mileage rate? You make that choice the first year you put a vehicle into use in your business, and you have to retain that choice throughout the life of that vehicle. If you take actual expenses, then actual expenses could include some depreciation on the vehicle. So all your gas, fuel, repairs, maintenance, whatever, tires, whatever you do for the vehicle would go into the actual expenses number. If you choose to do that, and then like I say, you have to track your business so you can calculate the business usage percentage, and you would take that as a potential deduction. If you do the standard mileage rate, you still have to track your business mileage. And you just take however many business miles times whatever that rate is for the year. So if you drove 2,000 miles for the year, then you'd have 2,000 times 54.5 cents a mile, and that would be your deduction for business use of the vehicle. Commuting in your vehicle is not deductible or reimbursable. Parking fees and tolls are deductible or reimbursable. If you have to pay to park at the hospital, or if you go on a toll road to get somewhere to visit on a visit or something, those things are deductible as business and are reimbursable if you have an accountable plan. Commuting is mileage incurred between your home and your primary work location. If you qualify to deduct a home office, you can possibly qualify to deduct or be reimbursed for mileage between your home and the church building. And we'll talk a little bit deeper about home office in a few minutes. So commuting mileage is non-deductible, non-reimbursable. So let's discuss how to figure that out. Once you've arrived at your primary work location, any mileage incurred conducting business is either deductible or reimbursable. If your first stop of the day is at a location other than your primary work location, you incurred commuting mileage to that location from your home and business mileage from that location. If you leave from a location other than your primary work location to go home, you've incurred commuting mileage from that location home. So let's talk some practicalities. I think we're to that point. If the church provides you a place to work, then you probably would not be available or allowed to have a home office. And I'll have a slide a little later on that talks about it, but you need to understand that as we talk through this. If you don't have a home office, then the church building is generally the location which is considered your primary work location. So if you are going from your house and stop by the hospital to make a visit, going from your house to the hospital would be commuting mileage. Going from the hospital to the church building would be business mileage. Whatever, if you left the church building then and went to a different hospital or went to a funeral home or went to visit a shut-in or whatever, that's still business mileage. Once you leave the church building and go home, unless you stop somewhere for business purposes on the way, going from the church building home is commuting. If you left the church building and stopped by a nursing home to visit somebody or a rehab center, that's business mileage to that location, and then going from that location home is commuting mileage. The IRS prefers that when you track mileage, that every day you state for every trip your starting mileage, where you were going, by address, your ending mileage when you get there, and the business reason for that trip. They prefer that you do all that by address. You know, left church building at 1360 or 1630 Piedmont Road, Marietta, Georgia. Went to Wellstar Hospital, Kennestone at whatever their address is. Because they want to, if they audit you, be able to go into MapQuest or Google Maps or something and put in those two addresses and see what that software says the mileage is between those locations. Now, you and I both know that there are times of the day when you don't want to go on a particular street, or you don't want to this or that. It may be a railroad track that, you know, crosses a busy road that, you know, the trains come through regularly. It may be, you know, whatever it may be. It may just be normal traffic. It may be a school zone. It may, you know, there are times when it makes sense to go a different route. So they could potentially get into an argument over, you know, why did you go 16.2 miles when it says 12 should be what you did, what you needed. They probably wouldn't argue if it was an occasional situation like that. But if every address they tested, it said 12 and you said 16, then they would start getting suspicious about what you're doing. So just FYI, if you're going to track business mileage, that's the way they prefer to do it. Now, I have, and I give to some of my clients, a mileage logbook. And it just vehicle mileage, and for every month it's got the date and the destination or the business purpose, and then on the other page, beginning and ending mileage. And I can't read it without my glasses. Yeah, and how much, or your beginning and ending odometer reading for the day, and how much was business and how much was personal. You can go to any office supply place and buy those for $2 to $3 to $4, $5. I don't remember how many dollars they are now. Hadn't bought any in a couple of years, but you can do that and use that as an easy way to track your mileage. If you've got a smartphone, there are apps out there that will track your mileage, and you can pull up the app and say, I'm on business, and I think some of them even give you the ability to type in who you're going to see and why. You know, there are ways to track your mileage, either manually or through some app or whatever, and then once a year you just summarize that and either take the business expense at the mileage rate, or figure out what your business usage was from your total mileage and take your actual expenses times that percentage. If you combine business and personal travel in a single trip, you must allocate expenses between the business and personal portions, and you can only deduct or be reimbursed for the business portion. Allocation must be made on a reasonable basis, and some of the reasonable basis would be a percentage of time or a number of days or some other reasonable basis. But the deduction or reimbursement cannot exceed the amount you would have incurred had only business travel been involved. So, example here. You know, you're in Missouri, Brian, and you know some congregation in Florida says, we want you to come down and hold a meeting for us. And you say, well, man, this would be a wonderful time to go visit Disney World, or a wonderful time to go to the beach with the kids, or, you know, whatever reason you may want to do. and you mix personal and business. Going to hold the meeting is business. So if you're going to do that, you have to track business versus personal and do some reasonable allocation between, so that you only get reimbursed, or you're only allowed to deduct the business. When counting days versus business days versus personal days, travel days and weekend days are not considered. I'll give you another example. 2016, late October, early November. My wife and I flew from Atlanta to Honolulu, Hawaii on a Thursday. We did some touristy things in Honolulu on Friday, on Saturday. On Sunday, we went to church at the, oh, my mind's gone blank now. Pearl Harbor Church of Christ. Sunday afternoon, we flew from Oahu, Honolulu, to Maui. Went to church Sunday night on Maui. And then Monday through Friday of that week, I did continuing education on Maui. 5 days worth of continuing education. And then Saturday, we did touristy stuff around Maui, and then flew out of Maui and came back home Saturday night, got back in Sunday afternoon. So we were gone about 10 days. But when you count business days versus personal days, travel days and weekend days aren't considered. So we flew out on Thursday. We had Friday that we did touristy stuff. We don't count Saturday, Sunday. We count Monday, Tuesday, Wednesday, Thursday, Friday that I was in continuing education. I have to have 40 hours every year. I took 30 of those 40 hours. Those 5 days I was on Maui. So 5 of the 6 days were business days. 1 of the 6 days was a personal day. Now, we talked earlier about you can only deduct things for the person involved. I think we said that. No, here it is. If your spouse and or children accompany you on a business trip, you may only deduct the expenses incurred for those who are involved in the business, i.e. you go speak at a seminar and your wife conducts women's classes. Then both of you are involved. If no additional cost was incurred, you may deduct the full amount, i.e. you drove somewhere to hold a gospel meeting and you took your family with you. You're going to incur the same mileage cost, driving cost, whatever, whether you go or the whole family. So you deduct all of it. In the situation we're talking about, I can't deduct my wife's airfare. I can't deduct her portion of meals, but the room cost was the same, whether she was there or not. The rental car was the same, whether she was there or not. So the vast majority of what's there, I get to deduct in full, but I just, I don't get to deduct her airfare or her meals. Beyond that, everything else is fully deductible. So if you want to go to Maui, I can give you the preacher's name there at the church in Maui. Meals and entertainment. There are 2 rules associated or related to meals and entertainment. You can deduct them if they are either directly related to the active conduct of your business or associated with the active conduct of your business. If they are either directly related or associated, then you get to either deduct or be reimbursed for them. Directly related must meet the following 3 tests, and they are all 3. It's an and test. All 3 have to be there. The main purpose was to transact business. you did engage in business during the period, and you had more than a general expectation of deriving income or some other specific business benefit at some indefinite future time. So if you go over and just, if you're doing something not for the purpose of transacting business, then you fail the test. It would not then be directly related. To be associated with, then you have to be able to demonstrate that it was associated with the active conduct of your business and occurred directly before or after a substantial business discussion. So we go back to that first slide. If it is directly related, then you met those 3 tests in that next slide. If it's associated with, then you conducted some business, but you did, say you went out and met a guy and y'all talked business and then you played golf. Well, in the golf round, was the main purpose to transact business? Probably not, because you spent 3 or 4 hours playing golf, but you spent 45 minutes to an hour in discussion. So the main purpose was probably not to transact business. You did engage in some discussion during the period, but not necessarily business. So here, the playing of the golf would be an associated expense. You had a substantial business discussion either before or after, directly before or after, and that gives you then the ability to potentially either deduct or be reimbursed for your business expense because it's associated with the business. Books and subscriptions to professional journals are deductible if the useful life of the item is short. If the item has a long useful life, it should be capitalized and depreciated over 5 years. Alternatively, you could claim a Section 179 deduction for the item subject to income limitations. And by that, I mean Section 179 is where the IRS allows businesses to write off fixed assets or long-lived assets immediately when they're when they're purchased. So you can buy a library, for example. A library is going to last a while, and I'm assuming a physical books library, not a software library. So the software library, I would argue that it would not last as long because of the update issues, as well as the ability to keep using it for extended periods of time. The way the computers are running now, older software just won't run anymore. But a physical books library, I would argue that it is going to last for a long time, and therefore you should either capitalize it and depreciate it, or you should claim all the cost as Section 179 cost in the year in which you buy it. If you get reimbursed for it, the note there at the bottom of the page, who owns the item? If you bought a new Truth for Today commentary, for example, and the church reimbursed you for it, who owns it? The church does. If you leave, and we had briefly this discussion when we were talking about annulment and some of those other issues. So if you leave and you take that with you, it's not yours unless the church gifted it to you. So if you went out and bought a library and asked for reimbursement of it and the church reimbursed you, then they own that library. Now, if you leave and they want to gift it to you, that's fine. Based on the intent of the donor, is whether or not that's income to you. And I would argue that it probably would not be income because they just want you to be able to use it. They're not intending for you to have to pay to get it. So that would be my argument, but it's based on the intent of the donor, as we discussed a few weeks ago. So you can subscribe to, and I don't know what any of these things cost anymore, but Gospel Advocate or whatever else, Firm Foundation, I don't know if it's even published any longer. You can subscribe to those things and deduct those as business expense. Education expense. Any employer can reimburse any employee up to $5,250 or pay directly up to $5,250 for education expense, and it not be income to the employee. Any education expense that you incur that is required by your employer or by law or regulation to keep your salary, your status, or your job, or that maintains or improves the skills required in your present work are deductible unless it either is required to meet the minimum education level to qualify you for your trade or business, or is part of a trade of study, a program of study that qualifies you for a new trade or business. So, for example, you decide that you want to teach school and you don't have a degree from a college that enables you to teach school, but the principal or the superintendent or whomever, and they agree that they will hire you contingent upon you going back to school and getting a teaching degree. That expense to get that teaching degree would not be deductible because that is the minimum education level to qualify you to be a teacher. So that's that exception number one. It's required to meet the minimum education level to qualify you for that trade or business. Say instead of being a teacher, you are a preacher and you know that you have difficulty counseling members, whether it be marriage counseling or just life counseling or whatever it may be, grief counseling, whatever the issue may be. So you decide that you want to participate and go get a degree so that you become qualified to counsel. If that degree program qualifies you to be a counselor, exception number 2 then applies. You would not be able to deduct or be reimbursed for that expense. Well, let me strike the be reimbursed for. You can, if it qualifies you for a new trade or business, the IRS is going to argue that it's not deductible by you. And there have been a lot of case law over the years of people trying to deduct education expense. They'll take an MBA program and they're working in a business, but the MBA program qualifies them to be a manager when they weren't a manager earlier, and the IRS is going to argue against them deducting it. This has a lot of case law behind it. But the employer can reimburse anything. Well, first off, they can pay up to $5,250 a year without it being income to you. They can reimburse you for expense and deduct it on their side as long as you meet item number 1 or 2 required by your employer or by law or regulation to keep your salary, status, or job, or maintain or improve the skills required in your present work. So in those situations, you potentially could deduct or be reimbursed for by your employer education expense. As long as you don't fall afoul of those last two criteria, that you had to have it to meet the minimum education level or be part of a program of study that qualified you for a new trade or business. Office supplies and equipment, including computers, may be deductible or reimbursable if they are purchased for use in your job. For example, you go to the office supply store and buy a mileage logbook. That's deduction. Or are required by your employer to fulfill your job duties. So if the eldership or the men where you preach say, we want you to be able to do PowerPoint. And in order to do that, you have to buy a computer and software for PowerPoint. Then that makes it deductible to you. It's required by your employer to fulfill your job duties. Be sure
What about buying a suit for preaching?
We'll get into specialized clothing in a minute.
Okay.
Be sure to keep receipts for anything you spend over $75. That's the IRS rule. If you spend more than $75, you have to have a receipt. And you have to document the business purpose regardless of the amount. Office in the home, we talked briefly about this earlier. To be deductible, an office in the home must be used regularly, exclusively for business, at the convenience of the employer, and as the principal place of business. So let's talk about what those things mean. Regularly, that means you use it more than infrequently, more often than infrequently. It's not that you have to do it every day or even every week, but you have to use it with some degree of regularity. Although I would argue if you're not doing it something at least once a week, you're probably not having a lot of regularity there. But exclusively, that means that that portion of the home that you call the office has to be used exclusively for business. Now, does that mean if you've got a spare bedroom and you call the whole bedroom the office, you have to use that whole bedroom exclusively for business? If you've got a spare bedroom and half of that spare bedroom you use for your library and you use for a desk for you to have your computer and study at and those sorts of things, that portion of the room that occupies that space could be considered exclusive for business. Item 3, at the convenience of the employer. IBM, for the last many years, has quit renting office space. And they tell their employees, you work from home. That is the convenience of the employer. If you, as I said earlier, if you are provided a place in the church building for your use, for study, for meeting members, for doing whatever, then generally you cannot show the convenience of the employer being that you work at home. Item 4, being the principal place of business. If once again the church provides you a place at the church building, you probably are not going to fulfill item number 4 as the principal place of business. So you could have something that you did at home regularly and exclusively, but if you didn't have the convenience of the employer fact and the principal place of business fact, it's non-deductible for the business. Second item there. If you have designated housing allowance And as we advised a few weeks ago, you have designated your housing allowance more than you anticipate you will spend because you want to be sure you maximize as much as possible the benefit of that housing allowance. And therefore, anything you spent for your home, and before I make this statement, let me tell you what you get to deduct for business use of the home. You get to deduct a pro rata portion, a percentage of the total square footage or the total number of rooms or whatever, some pro rata portion of mortgage interest, of real estate taxes, of utilities, potentially depreciation, homeowners insurance, any repairs and maintenance. So if you have fully deducted all those costs under housing allowance, and all those things we talked about fall under housing allowance, then you don't have any expenses to deduct for office in the home.
So in my situation, I should, because I think I would be able to, to actually put this one into practice for my home being my office.
Right.
Church so I could probably,
a place.
Yes. So I could actually, since I'm not able to do a housing allowance for 2017, I should still be able to use this as part of my tax return this year.
Right. And in a rental situation, you would get to deduct that percentage of the rent, that percentage of any insurance you had on the rental, you know, your personal property, renter's insurance, whatever you may have, any utilities, that same percentage of utilities, etc. So in that situation, yes, I would look at in your situation, claiming some home office, but you've got to figure out total square footage and then what part of that rental space is going to be used regularly, exclusively for business as the principal place of that business.
Okay. And now also the question I have, if I designate my home as my office, would my drive to services every time be deductible mileage?
If you call your home principal place of business, then going from principal place of business to somewhere else to conduct business, i.e. the church building, is not commuting but is business mileage.
Okay. I figured that, but I wanted to make sure.
Specialized clothing, here you are. Specialized clothing is clothing which is of a type specifically required as a condition of employment, is not adaptable to general or continued usage to the extent that it could take the place of ordinary clothing, and is not worn as ordinary clothing. So, if you buy a suit to preach in, I don't call that specialized clothing. If you were part of a denomination that required that you have a special collar or a special robe or a special this or that, and that you only wear that robe or that collar when you're in the pulpit, I would call that specialized clothing. My favorite example here is a guy that's on a construction crew and he buys steel-toed boots. That's specialized clothing because he doesn't want to wear those things everywhere else. He probably could, but they're not comfortable. He's bought them so that he can be safer on the job site. So, and they may be required as a condition of his employment. A smart employer is going to require that he have steel-toed boots. But if you have specialized clothing that is deductible, then the cost of cleaning and maintaining that clothing is also deductible. So I personally don't think that a minister buying a suit qualifies as specialized clothing. Therefore, having your suit dry cleaned doesn't qualify as deductible items either.
Well, that and when I bought one suit about a year ago, and the church actually reimbursed me for it, so I wouldn't be able to say that anyway, could I?
Right. Yeah, if they reimbursed you for it, you don't have any expense in it.
Yeah. Okay.
You can never deduct the cost of the first telephone line, and here I'm talking a landline, into your home. Now, that landline can be used as part of your expense for housing allowance, but you can't deduct it. Now, if you covered it as housing allowance, why would you try to deduct it? It's already covered as housing allowance. Any deduction of additional telephone expenses would be based on proving the business purpose of the expense and allocating the cost incurred between business and personal usage. However, once again, if all that cost, if you including cell phones in your housing allowance, you can't deduct them because there's no cost there left to deduct. It's been covered with non-taxable dollars already. A cell phone provided by the employer is not income to the employee if there is a substantial business reason for them providing it to you. So, if the church said, we want to buy you a cell phone and we want to pay for it so that we can be sure that anybody that needs to get in touch with you can get in touch with you, that's a substantial business reason. It's not income to you.
A quick question on that.
Okay.
Since I'm not able to use the housing allowance this year, say my cell phone, like, of course, me and my wife have a shared cell phone bill.
Yeah.
But if I was to use mine for business, for research, things like that, for studies and things like this to, further education, would that be deductible to me or no?
I would allocate that total bill between business and personal. Obviously, I don't know if you get billed separately for internet usage or those sorts of things, as opposed, most things nowadays are flat fee type things, including talk, text, and internet and, all those sorts of things. So if you're on one of those types of plans, I'd take somewhere between 25 and 50% as a deduction.
Okay.
If your half of the phone bill is half business and half personal, then I'd take 25%. If your half of the phone bill is 80% business, then I'd take 40%.
Yeah, I see what you're saying.
Yeah. All right. Mr. Deason. Mr. Deason was a minister that got audited in 1964. And as a result of the audit, the IRS argued that, well, let me tell you what he had done, and then I'll tell you what the IRS argued about. He had taken all his expenses and he had deducted them in full as unreimbursed employee business expense on 2106 that then flowed to the Schedule A as miscellaneous itemized deductions. When he got paid, some portion of his salary was housing allowance. So he did the fairly standard situation there. The IRS, when they audited him, argued that the housing allowance is non-taxable income, and therefore he had to prorate his itemized deductions or his deductible expenses between that which was related to the non-taxable income and that which was related to taxable income. That has become the rule for a minister. In fact, that's the biggest complication in preparing a minister's tax return, is the decent rule. Most of the software packages out there do a decent job, a good job of incorporating the decent rule into their software. So as long as you fill out the questionnaires correctly, then they will handle the decent rule. But basically what it says, if the example we've been using, the guy that makes $70,000 and $22,500 is housing allowance and $47,500 is is income. You know, 32.14% of his expenses would be related to that non-taxable income, so he wouldn't get to deduct that piece of his deductions, his expenses. You follow that?
Yes, sir.
And I came up with that 32.14% just by taking 22.5 divided by 70. So that's where I came up with the number. And you'll see that percentage in a couple of weeks. When are we doing? Oh, February the 8th, when we do the comprehensive examples of 4 possible tax return scenarios. We'll see that number, that percentage show up, because we'll talk again about the decent rule and the effect it has on the taxable income of these guys as we look through the ways we prepared, the potential ways we could prepare their tax return. All right. The decent rule does not apply to calculating self-employment income, since housing allowance is added back for that purpose. Decent rule does not apply to expenses reimbursed under an accountable plan. So let's talk about that. If the church agrees to reimburse your expenses and they have a plan in writing that defines that they will do it in accordance with IRS guidelines, the things we've been talking about, you know, we'll reimburse business mileage. We won't reimburse commuting mileage. We'll reimburse office expenses. We won't reimburse things you buy for personal use. We'll reimburse specialized clothing. We won't reimburse non-specialized clothing. You know, you get into those issues, as long as they're in accordance with the IRS rules and regulations on what they're going to reimburse, as long as that plan is in writing, and as long as you submit the reimbursement expenses in a timely fashion, and we'll talk in detail about some of these, I think next week is when we do all that, then that plan is deemed to be an accountable plan, and reimbursements under that plan are not income to you. Now, if you've been preaching for this place for a while and they're paying you this amount, and you go in and say, guys, I want you to start reimbursing me for expenses, they're probably going to say, sorry, we're paying you as much as we can. It's not, there has been a case where somebody said, well, let's just cut my salary and call it expense reimbursement. And in that situation, the IRS came in, audited, and found out what had happened, and it didn't qualify. They threw out the reimbursement. So there are some rules you have to live by, but if you can, as you negotiate employment agreements, the best thing to do is to set aside some portion of dollars. And if you've been doing this for a while, you should have some understanding as to what you may incur in a year as reimbursable expense, and have that reimbursed by the church. And if you say, you know, instead of asking for 70, if you in your own mind say, instead of asking for 70, I'm going to ask for 65 and have 5 as a pot of reimbursement, that's fine. You didn't cut your salary. You went into a negotiating situation knowing, or maybe you say, okay, we've set my salary this year, but in lieu of an increase next year, let's start setting aside some dollars for reimbursement. You're going to be better off expense-wise and income tax-wise if you have reimbursements done, as opposed to trying to deduct. Because remember, in 2018, that miscellaneous itemized deduction goes away till 2025. So you no longer have that if you're getting a W-2 and are an employee. Final rule item on this slide: decent rule does not apply to other types of tax-exempt income. So say you had some tax-free municipal bonds and you receive tax-exempt income from those, the decent rule doesn't apply to that income. It's only that housing allowance income that the decent rule applies to. All right, questions?
That last thing you stated, would that be like a Roth IRA type thing, or?
Yes, if you were drawing retirement out of a Roth IRA, that retirement income would not be taxable income, and decent rule would not apply to that type of income.
Okay.
Yeah. Any other questions?
No.
One other question I have is, I had a pretty major expense on the vehicle that I use, and I was just wondering, it's I use it for business and personal. So if you're claiming it, can you only write a percentage of the repair cost off, or can you write the whole thing off, or deduct the whole thing?
Well, let's get back to that right here. If you chose to do actual expense, then your total expense for that vehicle for the year times your business use percent.
Okay.
So the answer is you only get a portion of it.
Okay.
Now, what I would encourage you to do, and I'll give you my real life example. I bought a brand new vehicle in 2004. I tracked actual expenses, including my car insurance, every gas, every repair, every time I bought tires, every time I paid for my car tags, and tracked all of it. So the total cost of the vehicle plus all that, got that thing totaled out after about 5 or 6 years, and was involved in a wreck and totaled it out, and subtracted out the value I got from the insurance company for it. And I compared that to the number of miles I put on it times the IRS's mileage rate per year. And I was within $300 of the total cost.
So you'd have saved yourself a lot of time and hassle. Just doing standard mileage.
The standard mileage rate, and the IRS does a pretty good job of getting that number pretty well on. Now, I know people that want to do the actual expenses, fine. You've got to track business mileage anyway, because you've got to know business mileage to either calculate percent of business use or to calculate the however many cents per mile you get. So you got to track business mileage anyway. So yeah, you're tracking the same stuff. It's just easier to do the standard mileage rate. And my personal opinion is it works pretty well.
I see what you're saying. So they set the mileage rate to take into consideration.
That 54.5 cents a mile includes everything: the cost of the vehicle, the repairs, the maintenance, the car tags, the insurance, the gas and oil, and everything. So they do a pretty good job of calculating that. In fact, I think it was 2007 or 2008 when gas prices just went astronomically high. They changed the mileage rate during the middle of the year because gas prices had gone up dramatically. So they do a good job of tracking that and calculating what that number needs to be. And if you're satisfied just taking that, that's fine.
Yeah, that's more likely what I'll do.
All right. Any other questions? All right. Well, next week we'll finish up talking about some other items on the Deason rule and allocation of expenses and taxable, non-taxable income, and then we'll move the next week into the 4 different scenarios that we talked about for the tax returns. So I will go ahead and end our recording right now. Let me first stop the share. Okay. I'll end the recording now, and I'll put the video out there and send out a link to that later this evening. All right?
All right. Everybody have a good night.
All right. We'll see y'all.
Bye-bye.